Good day and welcome back to this video. Also today we'll be discussing and we'll be talking about a very important aspect of our trading. Yes, a very important and a very engaging and a very critical part of our trading. Alright, a very interesting part as well. Okay, so risk management, the lifeline of every trader. You can see from the topic risk management, the lifeline of every trader. So just a brief intro. This is on risk management trade psychology. Yeah, so we are just establishing some concept on risk management. Alright, so imagine you are sailing across the vast ocean, navigating unpredictable waves and changing winds. A seasoned sailor never sets sail without a well-calibrated compass. Are you getting the point? A steady boat and an emergency plan. Take note, because no matter how skilled they are, the ocean's uncertainty is always sure. You can say it's always a factor. Very important. So trading is no difference. It is not different. Yeah, it's never different. All right. So in the financial market, risk management is your compass. One, your boat and your safety net. Without it, even the most skilled traders will eventually be swallowed by the market turbulence. So now we can liken the market turbulence to what? To the uncertainty of the sea, which is always a factor. So now no matter how this seller is skilled, no matter how this trader is skilled, the trader is a very good trader, sniper entry, but in the financial market, you always need to have your guard, right? You always need to have your guard. If not, you will eventually be swallowed by the market turbulence. Take note. Right. Many traders focus solely on strategy, that is technical analysis, technical aspect of trading, where to enter the market, how to catch the big move, how to predict trade opportunity, buy low and sell high. But a profitable strategy, take note, even a 90% win rate strategy, as far as it's not 100, except you say you have a 100% strategy, then forget about risk management. But if you don't have a 100% winning rate strategy, please pay attention to what I'm about to say now, or else you will have to look for this later on. All right, so many traders focus solely on strategy, where to enter, how to catch the big move, but a profitable strategy without proper risk management is like driving a racing car without brakes. It is dead. Some traders aim for quick wins, risking too much on a single trade. I personally, I used to trade like that before, when you're just all about the money and you know that this market has the potential of giving you this money like today and very instantly. Why will you be, especially when it works for you, it works for you. All those risk management people will be talking about, it do not make sense to you at the moment. Why? Because it is as if you are going against the law of gravity and you don't know that whatever goes up will surely come down. Alright, so leave that for another time. Alright, so their entire capital wiped out in moments. Wow, 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 wow. Others become too cautious, never taking calculated risks, leaving them stuck in a cycle of missed opportunities. True mastery lies in the balance. Take note. True mastery lies in the balance. So what's the balance? Knowing when to take risks and when to protect your capital. Take note. This one now is another is a full video on its own, because if I start talking on this, it's a full video on its own, right? Alright, so let's remain on point. Okay, so think of a professional boxer. No matter how strong or skilled they are, their ability to block and defend against punches is just as important as landing powerful blows. In trading, managing risks means ensuring that even if you take a loss is just a small jab, not a knockout punch that ends your career. Please take note of this. You know why all these stories now, they are so that you can relate to it, right? So that you can relate to all of these situations, all of these circumstances I'm putting in place now. You get, because I might just say it in a theoretical form, and there is not you cannot attach to it. You're not getting the attachment how you're supposed to get, right? Why? Because I'm not communicating with some kind of expressible realities that you can relate with, right? So that is the essence for all of this story. So in this section, I will explore the art and science of risk management, how to structure your trades, control losses, and grow sustainably. Because in the world of trading, it's not about how much you make on a single trade, but how well you survive the long journey. Hmm? Towards consistent profitability. There was a time in my trading journey that I say, oh, it's not about making money, but can you make that money consistently? Can you be profitable consistently? That is what a successful trader is. A successful trader that can survive the seasons, the different season or the phases of the market. That is what a professional trader is. And a professional traders focus on growing capital instead of just making money, because number one, you are trying to preserve your capital and allowing the money flow, preserving your capital and growing your money. Why? Because if you don't preserve your capital, how can you grow your money? That means you don't even have money to grow and you'll be out of the market, right? So this is it. Risk management is important. Don't pay attention to this, what I want to say now. If you have a 100% win rate strategy, then this is not for you. But if you don't have 100% win rate strategy, then pay attention to this. Okay, let me explain. If you have a 100% win rate strategy, what does that mean? It means that you win in 100% of your trade. But if your strategy is 95% or even 99%, please take note, because that one trade that you miss might end up blowing your account. I don't know if you get me now. That one trade that you miss, it has happened to me severally, and it is a thing of, it's something of, it's something of learning the hard way. Let me put it that way. And I'm not likely to go through that route, except you want to just take it, you want to feel it how it feels like. Because there is normally say experience is the best teacher, but you might not really learn from experience. You might learn from understanding, or you can learn from, you know like in the Bible, Jesus Christ died. He died for us so that we will not die again, right? But now if you want to go and die the second time, it's left for you. All right, so pay attention to what I'm about to say now in the content of this section. All right, so dynamic versus static risk management strategy. So we have majorly three categories of risk management strategies. So risk management is the backbone of successful trading, ensuring that traders protect their capital while maximizing profit potential. Protect your capital first while maximizing profit potential. Two core approaches exist: static risk management and dynamic risk management. Understanding these strategies can help traders tailor their risk exposure to align with their trading style, as simple as that, and market condition. So the first approach is the static risk management. What is the static risk management? It's a fixed approach where traders risk a constant percentage of their capital on every single trade, regardless of the market condition or trade setup quality. So in this approach, traders they maintain a fixed risk plan, a very fixed risk plan. They do not deviate it. Risk 1% today, risk 1.5% tomorrow, risk 0.5%. No, just a fixed 1%, 1%, 0.5%, 0.5%, right? Yeah. So what are the characteristics? Risk per trade remains unchanged of your account balance. Two, ensures consistent risk exposure, preventing over leverage. Very important, very important. Then easier to implement, especially for beginners. This approach is very easy to implement, especially for beginners, because at some point when you start trading, you get used to this thing. You see your trade setup, you already know the lot size to use, and you know that this lot size, you're risking this amount of your trade. It will help you scale up faster, and as well helps traders stay disciplined and avoid emotional decision making. It helps you to stay disciplined and avoid emotional decision making. Why? Because what you maintain is certain amount of fixed risks, you know, it will help you confine the structure of your trading in such a way that you know that okay, this is your approach, this is your thing, and then subconsciously we keep on it, it will make you disciplined and you avoid emotional decision making. Alright, so example, a trader with a $10,000 account using a 1% risk strategy will risk only $100 per trade, whether the market is trending, is ranging, is consolidating, anyhow, is maintaining a 1% risk management. So what are the limitations? The limitations are it, you know, does not adapt to changing market conditions. So this risk management strategy, it does not adapt, it does not succumb to any changing market condition. It's just fixed. Whether the market is trending for you to make big money, it is fixed. Whether it is low for you to reduce your risk, it is just fixed, right? So it does not succumb to changing market conditions. So the next one is treats all trade equally. It treats all trade equally. There are some people that have A plus setup, B plus setup, C setup, as the case may be. So it treats all trade equally. None of them is A plus, none of them is B plus, as the case may be. Even if some setup are of high quality than others, it is 1%, 1% for all. May limit potential return if not adjusted to stronger setups. So this is very important again. In the market, what you are supposed to do, you are supposed to focus on quality setups, right? You focus on quality setups. So that now imagine you are risking 1% of a prop account where the overall maximum loss is where the overall maximum drawdown is 10%. That means you don't want to lose 10 trade because you're risking 1%, 1%. So because you don't want to lose 10 trade, you don't want to lose up to 10% drawdown, what will you do? You focus on quality setup. You will not just focus on any kind of setup, that you go for quality so that you can reach that 1%. Know that okay, yes, you are fulfilled. You reach this on a good trade setup. Alright, so this for static risk management. So the next one is dynamic risk management. So what is dynamic risk management? A flexible approach where traders adjust their risks based on factors like market conditions, trade quality, and probability of success. Alright, so this is for the professional traders. The professional traders, they have their unique way, their soliloquized way of doing things. They do it like they do it professionally. So a professional trader might look this way and say, okay, this is a C setup, risks only 0.5% in this setup. And then you might see this is a plus setup, risk 2% on this trade. So what do you see? The risk is inconsistent, right? It is inconsistent. So let's see the characteristics. So first, you say risk percentage varies depending on market volatility, right? Trade confidence or account growth. Okay, this is, pay attention. First, market volatility. In a trending market, we know that okay, this market is trending, you can go ahead to risk more because you have the potential of higher return. That is one. The next one is trade confidence. Like I'm saying, A plus setup. There are some trade that a trader will say this A plus setup. It is the person that is saying A plus setup. He is the one that knows what he mean. Me, I don't know. Me, I don't know what is A plus setup, but A plus setup is anybody can have A plus setup. Yeah. So the next one is account growth. Okay, so let's say we were risking 1% and then we were able to grow our account to 50%. Can you imagine? Maybe you're having $10K account, you grow it to 50%. 50% is $15,000 account. So you have $15,000 account, you can now step up your risk. Instead of risking 1%, now you start risking 1.5% of that account size. Hope you get the point. Yeah, take notes. Alright. So the next one is allocate higher risk to higher probability setup and lower risk to uncertain trade. So yes, so uncertain trade, you say okay, this trade I'm not too certain, I risk 0.5% because I'm not too certain. This trade is A plus, I risk 3% of my account capital. Those days I used to risk 3%, 4%. as well. Alright, so suitable for experienced traders who can assess trade quality effectively. So please take note, if you know you cannot assess trade quality effectively, my advice is maybe you can forget dynamic and stick to fixed risk management. The truth is that static risk management is the best because it helps you grow over time. Okay, yes, it helps you grow over time. You know why? Because when you stick static, you can track your progress. Because maybe an A plus setup does not an A plus setup now change to become an F setup, and you reach 3%, you lost 3%. Meanwhile, you have consistently built your account with 1%, 1%, and then you now enter one A plus setup with 3% risk, and you now lost everything, or you now lost half of what you might distort your psychological balance. So I don't know, okay. But static, my recommendation is static risk management. Don't worry, let's continue. So, example, a trader using dynamic risk management may risk 0.5% on a lower quality trade setup. This is what I've been saying. But increase risk to like 2% on high confidence setups with strong confidence factors. Remember, I've spoken about confidence. If you want to know more about confidence, check 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 a video in the section or in the playlist where you see trade conferences. Alright, so the limitation of this strategy is: number one, it requires experience in assessing trade setups objectively. So if you are not experienced, like I said, in assessing trade setup objectively, but experience in assessing trade setup objectively, it can be possible. A trader can be experienced with knowledge inside, but this one thing with the market is always right. Number one, the market is king. Number two, the market is, you know, the market is, how will I put it now? You don't know what to happen in the market to make money, and you don't need to know what to happen in the market to make money, according to Trading in the Zone by Mark Douglas. And as well, each trade, you're supposed to think each trade from a probability view, not from a plus setup view. Okay, so from this point now, I can use that to kick against this factor that experience assessing trade setups objectively. But you can be experienced, yes, you can be experienced to know that okay, this trade is a short trade. Yes, sometimes you can be experienced, but then don't risk 10% of your account on that experience trade. That's what I want to just say. So the next one is can lead to over risking if not properly controlled. You see, it can mess your psychology. This can mess your psychology. Maybe you see a trade and you risk 3%, you are not consistent. You cannot grow an account, or you like well, except you are really experienced. You cannot grow account well with this risk management strategy. The next one is more complex and requires continuous analysis. Yeah, it requires continuous analysis and journaling. Yeah. So the next one is hybrid approach. Wow. So let's look at this hybrid approach. It's a best for both worlds, best for all of them. So many professional traders combine static and dynamic risk management to balance stability and flexibility. So me, maybe I might be a hype, I might systematize a hybrid approach in my trading or in my risk management strategy. You know why? So let's see how it works. So one, based on static risks, a trader may use a fixed 1% risk per trade as a foundation. So this is me now, right? So I use 1% static risk as a foundation, and then I'm able to grow my account equity to 50%. You know what it means? It's massive. Consistently, it is massive. Growing your account equity to 50%, it is massive. Like, because it is proof that you know what you are doing. Not growing it in one day, but growing money is different from making money. So growing money takes time. So this is it. I always tell my people that you trade time with price. If you are investing, it's in a particular time interval, a particular capital with a particular time interval. So price with time. That is what you are trading. So now you grow money with time. Take note. So if I maintain 1% risk management and then I'm able to grow my account by 50%, I cannot increase it to 1.5% of my trading account. But then I'm having 100, I'm having 15, maybe $15,000 account. So if I'm having that $50,000 account, what can I do? That is still risking 1% of that is 1,000, is $150, right? But then is a dynamic approach because you know your account size is 10K dollars, but now your account size has changed to 15K dollars. You don't need to just you don't need to, you need to just at least you know that your account is 10K dollars. You get the point? So because the account is 10K dollars, you know that it has grown by 50%. You still know that your account is 10K dollars. So what you'll be risking is 1.5. But in this other approach where you see it as you are still risking 1%, which 1% is 1.5, it is not consistent because maybe if I grow my account by 10%, if I want to still risk 1% of my account equity now is everything, the profit plus the account balance. If I want to risk 1% now, maybe if I grow it by 10, I'll be risking 1.1%. Then if I grow it by 20, I'll be risking 1.20%. No, but dynamic approach is that at a particular time you now step it up. So adjustable dynamic risk, they increase risk slightly when the trade setup meets additional confluence or major market condition favour the trade. But me, I'm not using this, not adjustable dynamic risk. Like I just explained my approach. If I should grow my account to a 50%, if I should grow 10K to 50%, it's still 10K. Just have it for psychological reasons so that you not start saying that you have a this thing, maybe now you grow it to 60%, you now start risking you say you're still risking 1%, but you know that that 1% is as a result of the account growth. Your normal account is a 10K dollars. So hope you get that right. So example, if a trade aligns with a strong trend, is at a key supply demand level and has a high risk to reward, the trader may increase risk slightly. So this is another scenario as well. If market conditions are choppy or uncertain, the lower risk. Take note, right? But in all of this, I don't want to be found here because most times it's a trap. Most time you increasing your risks without understanding, like I just explained, it's a trap. And I don't want you to be found in that trap because one of the things you need to maintain in this your trading game is your psychology. You need to know how to maintain your psychology, and it's very hard. It's the hardest part of trading, but it's not really the hardest part. Everything is the hardest part, and everything is the easiest part of trading. It's just for you to focus on growth and leave perfection. You get the point? Yeah. So yeah, that is that. All right. So summary now: choosing the right risk strategy. So for beginners, start with static risk management to develop discipline and consistency. That is me telling you now. I'm giving you my advice. Remember, I said I will tell you. You remember? Yeah. So start with static risk management to avoid discipline and incons and consistency. Right? I mean, sorry, to develop discipline and consistency. Start with what? Static risk management. So the next one is what? Intermediate traders slowly integrate dynamic risks by assessing trade setup and volatility. This is for experienced people. Maybe if you have been in the game for a couple of years, you might have some kind of edge. You know how to define market conditions, and you are good. So that is that. For advanced traders, utilize a hybrid approach, adjusting risks based on probability and market structure. But me, at all point, I want to be here to grow my capital. Hope you understand my reason for that. They are very important. So key takeaway: the goal of risk management. What is the goal of risk management? Simply pause and read this. Pause and read this. What did I say? Simply pause and read it. So start reading it. Let's read it together. Key takeaway. The goal of risk management is capital preservation. Capital preservation. Very powerful. While optimizing growth. Capital preservation. One, while optimizing growth. Whether using static, dynamic or a hybrid approach. The key is what? Consistency and discipline in execution. And the other key is what? Capital preservation. So if you are using hybrid approach, if you are still preserving your capital, you are good to go. If you are using dynamic, if you are still preserving your capital, you are good to go. But like what I was saying, static is the best to help you track your growth. Yeah, to help you track your growth more easily. Yeah, so this is what we'll call this a we'll call this off today. Thank you very much. Hope you gain value from this. If you gain value, do well to destroy that like button, and as well subscribe for more wonderful content. Yeah, trust me, for more wonderful content. And as well, drop a reaction and a comment on your take concerning this risk management psychology on the comment section. Thank you very much. And as well, if you don't have a trading strategy, you can check out the video by the side for insight on day trading strategy. Thank you very much. Thank you.